yourself. Welcome back to Happy Hour.
Thanks, Rebecca. It's great to be here.
And Lee just said that everyone in her office, big fans of Happy Hour.
They are indeed. They all come into my office and they can't wait to watch it.
Oh, we tell them to come on down to the bar. Even if they're not on the show, just come visit us.
I will.
Actually, the bar's not as packed as it usually is today. But anyway, we digress here. You wrote in particular, I thought it was fascinating, and you actually inspired me to call the CEO and try to get him on our show. But we chatted a little bit about that. ING Direct. Talk about it.
Yeah, this is a really interesting little story that one of our writers did in the section that I edit. And ING Direct was famous a couple years ago when online savings accounts first came to the fore. A lot of people were putting their money into ING Direct. A lot of people didn't know it had a mortgage lending business. It started it in about 2000. And listen to these numbers. Countrywide, which is well known by now, had 94,000 foreclosures last year.
Right.
As we well know. This ING Direct had 15. 15.
Wow. Well, okay, what exactly are they doing differently? Yeah.
Well, basically, the CEO has this real, he's very old-fashioned in the way he lends money. When, they just basically make the loans and they sit on the money. They don't slice it and dice it and collateralize it and sell it out to all sorts of investors who then resell it to investors. As we know now, that's what led to all this sort of feasting on, which led to, lending practices that weren't totally, great, totally sound, shall we say. So basically, he really thinks that the 30-year fixed mortgage, in a way, is to blame for this whole mess because, you can't really lend money for that long unless you sell it out that way. So he just sort of lent it responsibly and had really high standards, and as a result, 15 foreclosures, not so bad.
And it's interesting that, because Wall Street saw that, hey, we need to get rid of these loans on our books to free up money to make more loans, but, ING Direct did the complete opposite, saying let's keep these loans and make money off the loans the traditional banking way.
Exactly.
Go figure.
Exactly.
And the other interesting about this company is that it's definitely online, has a huge online presence, but now in some cities popping up these orange cafes. There's one right here on 49th in Midtown. I would have passed by there and like, what the heck is that place? Like an Orange Julius, and people from California will know what that is. But so are they now going into the retail?
It's funny. They really did the reverse because initially when people kept hearing, oh, they have these really high savings rates, but you couldn't walk into a branch. You had to do it online, which some people were kind of funny about. They just couldn't get their arms around the idea that they could have be a customer of a bank that they couldn't visit and they couldn't see, even though they didn't need to. So they sort of did the reverse and did start opening branches a few years ago, and they're still moving forward on that.
And I tell you, so from the consumer perspective of all this, it's so annoying, and a lot of people aren't comfortable with their home loan being sold over and over and over, and then you have to change, if you pay via direct deposit, you have to change all that, and then you have to, go, if you're trying to figure out who's servicing my loan.
Right, you'll never know.
In 1 year, it can change like 3-4 times. And so this way, it may say something about their customer service that that's where you got your loan and that's where the loan's staying.
Right, and as a result, their standards are going to be a little bit higher. But, these days, everyone's sort of raising their standards, I think, based on what we learned last year. So
it's a really good story because a lot of people extrapolate from that and learn how they did it right. We're always talking about you doing it wrong, ING Direct doing it right. Thanks so much, Lee.
Sure, thanks for having me.
All right, Cody, what do you got for us?
Amen. I love people giving someone credit occasionally. We don't just throw the blame around. A little bit of street meat, guys. Let's bring out John Lonsky, Moody's chief economist. You know what we're talking about all day today. It's the Fed. The Fed cut from 5 to 2.25 over the last 6 months. You guys can pretend that it matters. I think cut another 75 basis points today if you want. I'm not going to play that game, though. John, welcome back to the show. How we doing?
We're doing well today, that's for sure. Huh?
Well, today, right?
It's a great day for the market.
For the market might have reacted nicely to it. Is the economy itself, are we finally getting through some of this credit crunch? Is the Fed cuts from the last 6 months from 5 to 2 actually starting to make a matter?
You are not going to get out of the credit crunch until equities do better. And I think that if you really believe that the Federal Reserve will be able to reduce the financial stress on the credit side of the economy, chances are the market value of common equity is going to be up by 10% by year's end from current levels.
Well, which is exactly the idea then that we do want to be buying now, because if we are through the credit crunch, the market's going to be up 10, 20. We'll be right back at the all-time highs. That's why I keep saying you want to buy the uncertainty, sell the certainty. We don't have any certainty right now, so the market's down. That's why you want to buy, right?
You can be quite nicely rewarded for assuming risk right now. Let's look at the federal funds rate. Put that against core inflation. It's now negative. The last time it did that during the previous recession was in October of 2001. Guess what? November 2001, that previous recession officially came to an end. who knows, we could be closer to an end to the current slump than we currently realize.
And that's what I keep coming back to. The market foresaw